Learning Objective 4 is going to introduce you to something called a multi-step income statement, which I feel is a very important statement to read. What you've been exposed to so far is what we would consider a single-step income statement, where we basically subtract all the total expenses from the total revenues, and you get your net income. It's the simplest type of way to put it together, and it's very, very easy to read. A multi-step income statement is a little bit more complex, as you'll see. So here's an example of a single-step income statement for this company, REI. I don't know, again, if you're familiar with Recreational Equipment Inc. REI is a retailer that sells anything from sporting goods to outdoor stuff. So it's sort of like a Dick's Sporting Goods and a Cabela's sort of wrapped into one. But here you have two fiscal periods. On the far right, the fiscal year that ended December 28th, 2013 is listed here. And then in the middle column here, you have the next fiscal year. Now, you would think the next fiscal year would end December 28th, 2014. Well, again, this is several days, about a week off from that. And so clearly they changed a little bit about their fiscal year, that period. So just know that these are back-to-back fiscal periods of time. And there you go, all your revenue is listed. And again, look how revenue is listed, net sales. And I think I remember telling you how important it is to understand what net sales are, right? Sales revenue minus your sales returns and allowances minus sales discounts. That's your net sales. Almost all the income statements you'll see from a merchandising company will simply have net sales as their main revenue account. Then you see all the expenses are kind of grouped up and totaled here. And then the difference is your net income. Okay. So one thing to understand when you're reading these financial statements, these numbers are not the full story. In this case, every single one of these numbers is listed in thousands. And so that means you're going to have to add 3 zeros to the number to figure out exactly how to pronounce it. So this looks like 2,217,131, but when you add the 3 zeros, it becomes 2,217,000,000. Okay, so just understand that that's really important. So from the previous fiscal year, where they had a little over 2 billion in sales, to 2.2 billion in this most recent fiscal year that's listed, that's a 10% increase. And says for retail, that's awesome. Anything in double digits is awesome in the retail sector. So the fact that they had a big jump in net sales is very good for this particular company. But if you look at the expenses, as I told you, how different merchandising is from the service businesses that we have been looking at up to this chapter, the largest expense that they have is the cost of
I can't hear you.
Is anyone else having that issue?
No, I can hear.
Yeah, I'm good.
You're good. Okay.
Must be me. I'm going to disconnect.
All right, thanks. So the cost of goods sold is the cost of the inventory. Remember, that's going to be the largest expense that retail merchandisers have, right? Everyone thinks that labor is the biggest problem, but actually labor costs are quite small in comparison to the cost of goods sold, the cost of inventory. So because inventory is so important, again, it starts as an asset, as you know, but when we sell it, we expense it as cost of goods sold. It's important to keep our expenses as low as possible. And so this is the reason why companies like Walmart, way back in the late 80s, early 90s, and it just expanded, they were pretty good. They were excellent, in fact, in lowering their cost of goods sold, lowering the price of inventory, by asking manufacturers to set up shop in China. 80% of the imported goods to Walmart come from China alone. And so they have a very good business relationship. What I mean by that, the corporation, Walmart and China and Chinese manufacturers, because they supply so many goods to the United States, and that's for a reason. It was a business decision, all right, to go ahead and buy more inventory from China, or ask manufacturers to manufacture their goods in China, because it was good for American business. And a lot of people like to blame the Chinese for a lot of that stuff, but it was really a business decision by a lot of companies. And I'm not picking on Walmart; all of them do it. Walmart was leading the way; everybody does it now. So it's not a very specific type of thing there. So a lot of people don't understand a lot of what's going on. It's easy to believe in other things, but that's why we rely so heavily on places like China, is to make our stuff that we buy. Is It's an expense. The cost of inventory, yes, it starts as an asset, but it ends up as an expense. And businesses have to keep their expenses under control. And so this is the driving force between, to import so many goods into places like Walmart, Target, other places that you shop. Most of it's imported. Payroll related, that's your labor expenses. As you see, it's much smaller, almost a third the size of the cost of goods sold. And places like Walmart, which of course, like a lot of retailers are set up, they keep their payroll expenses as low as possible. They hire and pay very well a bunch of managers, but they work those managers, 50, 60 hours a week. And then almost everybody else is more or less part-time, minimum wage or close to minimum wage type of workers. And so again, that helps control their labor costs substantially. And so again, these are the two biggest expenses retailers will have. And these are the reasons why they, A, import a lot of goods, B, keep their labor costs down by hiring basically part-time workers to do most of that particular work. The net income listed down here, again, the difference between your total revenue and your total expenses, right, is the net income. Again, this is in thousands, so it looks like only 44,000 until you add the 3 zeros, and it's a $44 million profit for their fiscal year ending January 3rd, 2015. That seems like a pretty good. I mean, no one's going to say no to $44 million, but when you started with $2.2 billion, again, this is your sales is what the customer paid for your stuff. They gave you that money because they bought something from you. If the customers are giving you $2.2 billion, and after you pay for all of your expenses, you're only keeping $44 million, that's a lot of expenses. As a matter of fact, if you were to break it down by every dollar that the customer gave you in sales, this would only be about 2 cents of that dollar. Okay, so about 2 cents of the dollar is your profit. And this is not uncommon. Walmart is, somewhere between 3 and 4 cents profit on the dollar. So that means for every dollar you give Walmart, 96 or 97 cents of that dollar is paying for all the expenses they have, and the other 3 cents or 4 cents, what's left, is their profit. So that's true across the board. We're talking about relatively small profit margins, net profit margins for many, many retail firms, which is why a lot of them go out of business. They can't survive after traumatic things, whether it's COVID or intense competition. Retail comes and goes lots of times because their margins are so low. Okay. The multi-step income statement is one of my favorite forms of an income statement. So it's just an income statement, but elongated. It shows you more information. 3 very important things that it does show you is it actually calculates the gross profit for you. So you will see the net sales, and right away the cost of goods sold will be subtracted to give you the gross profit. That is on the multi-step income statement. You don't get that on the single step. Of course, you can still calculate your gross profit on a single step. You take your net sales, subtract your cost of goods sold, you'll get a gross profit. But the multi-step, they give it to you, which is wonderful, of course, at the end of the day, they also give you your your net income, no problem. But the difference here is the second part is very interesting, because what the multi-step income statement does is separate the main operating of the business from everything else the business does, and tells you how profitable the core business is. Remember, the word income and the word profit mean the same thing. These are interchangeable terms, right? So what do we mean by operations? Is the main operation of a retailer is to sell merchandise. Classic example, you've probably been into the Walmart in Fishkill locally here. You walk into the Walmart, you see there's tons and tons of goods on the shelf. But another thing that's very interesting is there's a McDonald's right there. Okay. Well, Walmart doesn't own McDonald's. Walmart is renting that space to McDonald's, okay, in their store. On the other end of the building, they're renting that space to a beauty salon of some sort. That's not theirs. They do own the glass place, and they do own, I think they own the phone, little phone store that they have there. So that means McDonald's is paying rent, because Walmart's not giving them that space for nothing. Okay. Well, so Walmart is collecting rent from McDonald's for that space. Well, Walmart is making other money other than selling goods. Walmart is in the business of selling goods. So what this section tells you is what is the profit from them just selling their goods, which is that's what they do. And then they separate that other stuff from that, and they show that next. So the multi-step income statement, as you'll see, will tell you a lot more information about the core business and the other stuff that the business does. So let's get to it. Here is that same REI, back-to-back income statements for the fiscal year ending 2013 and January 2015. Same numbers, but now you have the multi-step format. So again, the first thing you notice is the gross profit is calculated for you, okay? So remember, the gross profit simply is the remaining revenue after they pay for the inventory. And that gross profit has to cover all the other expenses of the business in order to make a net profit, okay? So from the gross profit, all the operating expenses are subtracted, right? And this is the profit from the main operation of the business. So as you see here, REI had a $960,000 million gross profit after paying $778 million for operating expenses. Their profit from operating the business, which is selling their sporting and outdoors goods in their stores, was very profitable, almost $182 million in profit. But running their stores is not the only thing they do. They obviously do other stuff. And so here is that category of other stuff that they do. Other stuff that's not specific to selling goods. So that could mean, like for Walmart, collecting rent from tenants in their buildings, okay? It could also mean collecting interest income on giving out notes payables, notes receivables, right, loans. So it could mean any other types of fees that are, or things that they're collecting and earning that is not related to selling goods. Other is the category. Okay, so here they don't have any other revenue or gains, but this particular company has a large expense, what's called a patronage refund. And I'm not exactly sure what that is. All I do know is that it's shrinking its profit Okay, again, the word income is the same as profit. So in this case, it shrunk that profit from 181 million down to 71 million. Okay, so that's a big chunk of change to take away. Then, as you'll see on the multi-step income statement, the profits of a corporation are taxed. So they will add to it their estimated income tax expense. This is an estimate, it's not actually what they pay, but this is what they are expecting to pay. Because again, when you do an income statement, you're doing it at the end of a fiscal period. Sometimes that's December 31st. But your taxes aren't due, and for corporate taxes aren't due until August. And so, by the time you sit down and do all your taxes, things could change. So here you have an income tax expense that's estimated, and then you have your net profit of 44 million. Okay, but I would say that looking at the profit from operations, that's a very large increase in profit just from running the stores. Clearly, those patronage refunds, whatever the hell they are is draining a lot of that profit by the time they actually report out their net income. That takes away much of the joy for stockholders. Okay, so that's a multi-step income statement. Again, key things to understand: how do you calculate net sales? Remember, net sales is sales revenue minus sales returns and allowances minus sales discounts gives you net sales. This particular income statement is for PW Audio, our lovely business in the book here. So from our net sales, we subtract cost of goods sold. That gives us our gross profit. From the gross profit, all the operating expenses are subtracted out, and that gives us their profit from operating the main business. Now, even PW Audio has other stuff going on. Notice they have other revenue and other expenses. Other revenue would add to the profit. Other expenses would take away from the profit. So here they had $3,600 of other revenue that they added in and $2,000 of other expenses that they subtracted out. So it added a net of $1,600 to the profit. And now they have to take their income tax expense. That will be a rate that's given to you, so you can calculate. And what's left is the net profit. So you have to know how to read all of these. It's very, very important, particularly understanding the difference between the operating profit and whatever other things that they do, which we call non-operating activities, because it's not related to selling a good. It's all the other stuff. Okay. So that's really important, okay, to understand. Your book does introduce you to something called comprehensive income as well. I'm not going to get into this very much, but I will explain it. You'll get into details if you take like an intermediate course. But in essence, comprehensive income takes the net income that's reported and also includes other stuff like unrealized gains or losses that the corporation has in that period of time to get something called comprehensive income. Again, the important thing is just to focus up until net income and just understand that comprehensive income is, again, other stuff that's added to the income statement later on. Okay. So here's your do it exercise number 4 on the multi-step income statement. The company is Art Center Corporation. The year ending is December 31st of 2017. And here are all your numbers. And they're going to ask you to prepare a multi-step income statement. That's the most important thing. They're also going to ask you to add the comprehensive income. Okay, so you're going to add that later. However, the company has a tax rate of 25%. So once you actually do figure out what the actual profit is, you have to do an income tax expense. Okay. And it tells you that this rate is also true for this comprehensive income later on. So again, the focus is the multi-step. And multi-step income statements start with sales revenue, net sales rather. So how do you get net sales? You take your sales revenue, subtract out your sales discounts in this case, because there's no sales returns and allowances. So that's going to be your net sales. That's the first step, net sales. You subtract out your cost of goods sold, and that gives you a gross profit. From the gross profit, you subtract out all your operating expenses. That gives you your income from operations, or your profit from operating the business. Then you add all your other stuff. So you'll add other revenue, you'll subtract out other expenses. That gives you your total amount of income or profit before the tax. Take 25% of that as your tax expense. The difference is net income. This is what it would look like. Okay, net sales, sales revenue minus sales discounts, since there's no sales returns and allowances here. Subtract out cost of goods sold, you'll get gross profit. From the gross profit, you're subtracting out all your operating expenses to get your income or your profit from operations. Then you have to take into consideration all that other stuff that you do. So you're going to add in other revenue and gains, subtract out other expenses and losses. This means that this is going to add another $5,000 to your profit. So your total profit before your income taxes is $113,000. You take away 25% of that as your income tax expense. That rate was given to you, and your net income $84,750. This you need to know how to do. Now, in terms of the comprehensive income, there was an additional $10,000 that was made, but that's also subject to tax. So we would simply add in the $7,500, which is left of the $10,000 after you take out the tax. So otherwise, that's a very important statement to know how to read and how to do. Learning Objective 5 goes on to explain something we've actually looked at in Learning Objective 1. Okay. Learning Objective 1, we learned about how a periodic income inventory system works. This is the tabular form where it starts with the beginning inventory that's in the store. You're adding all of the costs of the inventory you bought, because you're always restocking the store. And that gives you the total cost of everything that's available for sale. And like I was mentioning, only two things can happen to inventory once you buy it. You either still have it in the store, so you subtract out the ending inventory. Whatever is not there is your cost of goods sold. From Learning Objective 1, you might have known that from, it was given to you in sort of a graphic form with the boxes, where you started with beginning inventory, then you added in your cost of good, all the stuff that's purchased to give you the total amount that's available for sale. And then only two things can happen to that. It's either still in your store, which is the ending inventory, and whatever's not there is your cost of goods sold. So your beginning inventory is box 1. The cost of all the goods purchased is box 2. The total of those is box 3. Subtract out what's left in ending inventory, or subtract out box 4, and that leaves you the cost of goods sold, which is box 5. So this you've seen, again, from Learning Objective 1. If you want to go back and look at this illustration, you'll see that exact illustration. Well, it'll look a lot neater than what I just drew, but you'll see that exact illustration there for you. How it actually looks on a statement works the same way, right? The first step is, what is the beginning inventory? So in January, you had 36,000 of beginning inventory for PW Audio. All right. The second thing is you're going to add in the cost of all the inventory you bought. So you're buying inventory, but like I said, sometimes you send things back, sometimes you take a discount. and you have to always add in your freight. So you have 36,000 as beginning inventory. That would be in box 1. You bought $320,000 worth of new inventory. That would be in box 2. The total available inventory for sale is $356,000. That would be box 3. At the end of the period, you take a look at what inventory you have left at the end. That would be box 4. You subtract that out, and the difference is your cost of goods sold, which is box number 5. So this is something that, again, we went over this in Learning Objective 1. It repeats here in Learning Objective 5, so you can actually do it. And it's not that bad to do. Okay, and again, if you really want to follow the system that I showed you, or just do it in tabular form, it's really kind of straightforward. So here you have the accounting records for Aerosmith, yay, rock on, as of December 31st, 2017. Aerosmith uses that periodic system of inventory where they have to do those steps, and they want you to compute the whole thing, but tell them, A, what's the cost of the goods that have been purchased, and then B, at the end of it, what was the cost of goods sold? Okay, so you know how it starts. Box 1 is the beginning inventory. So beginning inventory would go first. The second box would be the purchases, which would also give you the answer to the cost of the goods purchased. So box 2 is more complex, right? Because it starts with purchases. Then you subtract out your purchase returns and allowances. You subtract out your purchase discounts, and you add in your freight, right? Does that make sense? That gives you the cost of the goods purchased. When you take the beginning inventory and you add it to your product from step 2, that'll give you the total available for sale. You subtract out your ending inventory and you'll get the cost. So that's how the steps would work. This is how it would look, right? Step 1, what is your beginning inventory? Step 2 is the purchases, right? So you start with the purchases, you subtract out any returns and allowances, you subtract out any discounts, you add in your freight. So box 2 would show the total of the purchases, which happens to answer the first thing they asked for. Box 3 is the total between the beginning inventory and all the purchases you made. Okay. The fourth step is to subtract your ending inventory, which they gave you, leading you to the fifth step. What is the cost of goods sold? Well, it's just simply the difference. Okay. So that's also something you need to know how to understand, get done. And this chapter ends with some financial analysis. And this is really good financial analysis to know because you've seen it if you've ever watched an episode of Shark Tank, which I'm sure a lot of you have at one point in time. But what you'll hear them talk about is what are you selling your product for and how much does it cost to make it? Well, they're really trying to figure out what the gross profit rate is of these products. And so that's really important to understand that these financial ratios that you're being taught are actually real life active ratios, that these are used all the time. So a gross profit rate, we used to call it a gross profit margin. Some books back in the day used to call it a markup. Those words are still used today. But basically, they take the gross profit of the company and divide it by the net sales of the company. That's a gross profit rate. That's about it. So you have gross profit over net sales. So how does it work? Well, it's a very simple ratio, as you see here. It's simply your gross profit divided by your net sales. Both of these numbers come from that multi-step income statement or an income statement. You could calculate gross profit, right? Because it's simply the net sales minus cost of goods sold. That's your gross profit. So for REI, we're going to focus on 2014 numbers here. They had a gross profit of $960 million on $2.2 billion in sales. That means they had a 43% gross profit. Now, that's a lot. That's a very, very high amount. It's a very, very high amount. What does that mean? Now that we know the percentage of it, we can actually break it down into a very simple example of a dollar. Okay, so this dollar is their actual revenue, right? For every dollar they collect from the company, okay, they certainly will subtract out their cost of goods sold, which they don't give you here. But we know that 43% of that dollar is the gross profit. So 43% of the dollar is simply 43 cents. So noting that for every dollar they receive in sales, which is what they're collecting from the customer, after they subtract out their cost of goods sold, they are keeping 43% of that as their gross profit, which means 43 cents on every dollar is the gross profit. Now, because you already know the sales revenue and the gross profit, you can calculate your costs, right? So in this case, for REI, they're forking out 57 cents out of every dollar just to cover the cost of inventory. Okay, cost of goods sold is the cost of the inventory. So that tells you a little bit about that. And again, gross profit isn't the end of it all, right? They have to subtract out all the operating expenses, et cetera, to get to the net income or net profit. So this is just the start. When you look at Dick's Sporting Goods, which is one of the it is probably the largest sporting goods store we have in this country right now. For the same year, their gross profit margin was only 31%. So when you look at the average for Dick's Sporting Goods, for every dollar in revenue that they collected from the customer, again, that dollar is sales revenue, that 31 cents is gross profit. You can see that their cost of goods sold here is quite high, right? 69 cents. Much higher. So they're paying a lot for their inventory because their cost of inventory is very high going out. Okay. Dick's is closer to the industry. This particular industry, of course, is the retail stores that sell sporting and outdoor stuff. The industry as a whole has about a 34% gross profit rate. So again, for every dollar that the customer is spending there, that's their gross profit from each and every dollar. Okay, so once you break it into a percentage, we can break it into a buck. So instead of looking at really large numbers like 2 billion or 100 billion, or in Walmart's case, 500 billion, we can actually break it down into just what the average dollar looks like at a corporation. When Dick's collects a dollar from the customers, the first thing they're doing is spending 69 cents of that to cover the cost of the inventory, leaving them with 31 cent gross profit. For REI, it's a little bit of a better picture, right? Because they're spending less on their inventory and they have a larger gross profit. But gross profit is not the same as net income, which is what stockholders want. They want to make sure that at the end of all of this, there's a good chunk of net income for them. So that's your second ratio. The profit margin looks at the net income compared to the net sales. That's really all it is, okay? So the profit margin, we used to call it a net profit margin back in the day, but anyway, it means the same thing. Net income compared to net sales. So how it looks in a formula is this: net income divided by net sales. So the net profit over net sales. Well, it's a little bit of a different story now for REI. When you look at their 2014 numbers from their income statement, remember they had a $44 million profit. That's their net income, divided over 2.2 billion in sales, which means that after everything is said and done, they're only keeping 2% of every dollar as their profit. That's the net profit. So that means for every dollar they're collecting in a sales revenue from their customers, 98% of that dollar is costs. It's all expense that they have to cover, leaving them 2% of every dollar, 2 cents of every dollar as their profit. Now that might not seem like it's great, but retail is highly competitive in many areas. Walmart is only keeping roughly 3 cents, sometimes 4 cents on every dollar. So it's not like, this is outrageously low. It's okay. I mean, it's not, I wouldn't be writing home bragging to mother about it, but it's okay. Here's where Dick's Sporting Goods really shines. They are doing incredibly well when it comes to their profit margin. Because even though they had a very high cost of goods sold, clearly their gross profit rate was lower than REI's. However, they're obviously controlling all their other costs quite well. Because at the end of it all, they're keeping over 5 cents out of every dollar, right? 5.4% of each dollar is their profit. Right? So that's much, much better than REI. And actually, it's a little bit better than the industry as a whole. So the industry as a whole roughly has about a 5% net profit margin rate, which means that after the customer gives them a dollar and they take care of all their expenses, they're left with 5% of that dollar as their profit. Each and every dollar, of course. Right? Can't make a living on a dollar. So that's important to know. This matters a lot, and that's another thing you're going to hear that on Shark Tank a lot. What's your margin? Right, you're going to hear that all the time. Okay, what's your gross margin? What's your net margin? You're going to hear that a lot because they're investors. They need to know this stuff, right? And you do too. All right, so do it exercise number 6 reviews both of these ratios. The gross profit rate, which as you know is the gross profit divided by the net sales. That gives you a percentage, right? And the profit margin, which is your net income over your net sales, and that also gives you a percentage. So here they have Rachel Rose Incorporated. They have this company's numbers for 2 separate years, 2017 and 2016 here. They don't actually give you the gross profit, right? But you know that gross profit is simply net sales minus cost of goods sold, so you can calculate it yourself. Okay. Here it's the profit margin is easier because they give you both the net income and the net sales, so those numbers are easy to find and easy to calculate. So when you look at the gross profit margin rate for this company, their cost of goods sold subtracted from their net sales gives you your gross profit divided by net sales. So in this case, each year they're still working on a 50% gross profit margin, which is really great. Really great. Okay. Let's see if their profit margin is a little better. Well, that profit margin, again, is the net income compared to net sales. And in 2016, that was really high, 60.7% profit margin was very, very good, but it's even better in 2017. Yes, it's true that they had less sales in 2016 and 2017. And it looks like they actually have less profit. But in fact, they're keeping 22.5% of every dollar they collect in sales, which is outrageously good. How outrageously good is it? You have to be Apple to have a similar rate. Apple is an extremely profitable company, and their profit margins are roughly about 20-21%. So they're terrific in that regard. So that's how we end chapter 5. Questions?